this is John Bartlett from Brentwood Growth. We're continuing our series of interviews with buyers on the Sell or Scale podcast. I'm pleased to have Ariez Dustoor with me today with MB Group. Ariez, how you doing, man?
Doing good. How are you, John? Thanks for having me.
Good. Thank you for being on this. Where are you calling in from?
I live and work out in Miami.
Got it. Well, good. Well, so the way we always start this, tell us a little bit of your background, a little bit about MB Group, the sectors that you guys are looking for partners and acquisitions in. Give me some background.
Yeah, sure. So I run a private equity firm that I started in 2017 with a partner of mine. And, our firm really specializes in being the first institutional money or investment into founder or family-owned businesses anywhere in the US or Canada. And we focus on two core sectors, one of which is probably relevant for your listeners.
Mhm.
And that first sector is what we call multi-location services businesses. And this would include both consumer services as well as business services. But really any type of business where there's some physical aspect to the business, whether it's a store or it's a fleet of trucks, and or the expansion of the business, the growth of it is tied, at least in large part, to physical or geographic expansion. So a space, for example, that we've been spending a lot of time in recently that would fall under this multi-location umbrella is residential services, different types of residential services, as well as commercial services. So on the residential services side, that would include things like exterior services, whether it's roofing, it's siding, other aspects of that, like garage door install and repair. So that'd be an example on the residential services side. And then on commercial services, we've been looking, for example, at different sub-niches within facility services. So, different types of specialized hard surface cleaning as one example. And we really specialize in, coming into these businesses and working with, we don't run them day to day, but we're, I would say, a fairly hands-on owner, where we come in and we want to work with them very collaboratively to both accelerate the growth of the business and then also kind of try to professionalize it for the next phase of growth.
And what, two questions, what makes these sectors attractive to you? And then what makes a business in these sectors attractive to you?
Yeah, so I think each sector is different, right? And each sector has its own nuances that you have to be watching for that make it more attractive or red flags. I would say broadly speaking, we like these businesses for a few different reasons. I think one is that these tend to be markets that are growing at an above average rate. That's one. So there's growth opportunity just from market growth. I think the second is that these markets are large and tend to be highly fragmented. So there's in a lot of cases, very small players. And so there's an opportunity for us to help and work with the team to build larger scale players that can be, regional or market leaders. And that brings a lot of benefits. And then I think a third aspect is that these businesses often, depending on the business, they may have characteristics that make them, from our perspective, have high business quality. So, as an example, you have businesses where there's oftentimes a highly recurring element, so that provides repeatability and insight into where comfort that the business is stable and revenue is going to remain. So an example of that to be more concrete, would be a space we spend time in is pool services. So
Hmm.
residential pool servicing, or in some cases, it's doing it for a pool in like a condo or HOA complex. And so, if you live in a market like I do here in Florida, I mean, you can't, if you're going to have a pool, you have to maintain it. And
Right.
if you don't want to do it yourself, and it's a huge pain to do it yourself, you need to do it on a recurring basis. And that tends to be a contracted business. And so you have this contract, and if you're doing a good job and your pricing is competitive and you provide high quality service, it's likely that the homeowner or other customer is gonna keep you around. And so that's attractive. In terms of, I think your second question was, what are things that we maybe watch out for? Was that right, John?
No, okay. So pool services is an example. That's a sector, and these are the characteristics that the sector has that makes that sector interesting for you. And so when you're looking at a specific opportunity within that sector, a company, and you're trying to evaluate, is this company attractive or not to us? What are some of the things that you're looking for specifically, um, within that company? Revenue size, profit margins, infrastructure, tech
Yep.
stack, your dependency, number of employees. What are some things specifically?
Yeah, I mean, I would say all of the above, but some things I would highlight are and I think particularly the spaces that you and your clients spend time in are, one thing we're going to look at is what's the mix between installation or one-time revenue,
Hmm.
and then something that we would describe as more, maintenance or recurring.
Right,
And what does
right,
that dynamic look like?
right,
So we have a preference for businesses where there's a higher mix of maintenance or recurring revenue. I mean, in a lot of these sectors, the install portion is far and few between. You don't replace your roof very often. You don't build a new pool very often. You don't replace your garage door very often.
mhm,
So that's one piece of it. I think the second is, I mean, we tend to be we're a growth focused investor. So what gets us excited, we have fun with, is finding businesses that we can help grow. And so
mhm,
typically those are going to be businesses that have a history of growth.
mhm.
So we would rarely come into a situation where a business has been totally flat
Right,
or declining and sort of
right,
feel like, well, this is a good opportunity for us to come in and now turn the business around. That's not really what we do. So I think a history of growth, ideally, the more history and more consistency, the better.
right.
Um, I think team is important. I think it's an area that we can help with a lot after we've been involved. But I think a business that where there's no infrastructure and it's incredibly reliant on just one or two people or just the owner, and sometimes it feels like this business might fall apart if something happened to that person. Um,
Right.
that can be sort of something that we would struggle with. Um, and then I think we also, there's other aspects we look at, things like ticket size. So, what's your average customer
Right.
value?
Right.
Or you want to make sure we're avoiding customer concentration, particularly in businesses that are commercial and maybe have larger contracts. If you have one customer that's 50% of your revenue, that's something we're going to struggle with. So different things we look at, but I would focus on, what's the type of revenue, what's the growth trajectory of the business, and then, probably team or kind of infrastructure quality are a couple things I'd highlight.
Let's talk about size. And so, if it's a sector that you've already made an investment in, um, it, and you're looking to expand sort of the investment that you've made in that sector, and so, um, if within that sector, if you're looking to expand to sort of maybe establish a hub in a new geographical market that's within the general region, what size company would you be looking for in order to expand? And then if you're already in a metropolitan market, what size company would you be looking for as sort of an add-on tuck in to an existing location that you have?
Yeah, I mean, it's hard to answer the question to give
Yeah.
a concrete
Mhm.
answer because some of it depends on, I mean, how big is the company, the
Right.
platform? So
Right.
if we have a company if our platform, let's say on the small end, has $10 million of revenue, uh, expanding into another geography by buying another company with 10 million of revenue is a very different look and feel, right? Than if you have a company with 100 million of revenue and you're expanding with 10.
Yeah.
So I think a lot of it's going to depend on what that current company looks like. But I think there's probably different flavors of these types of tuck-in. We would call it a tuck-in or kind of add-on
Yeah.
acquisition. I
Yeah.
think there's going to be ones that relative to the platform are pretty small. And in some ways, those are probably a little lower risk for you to do. And then I think there's going to be larger acquisitions that are much as a percentage of the existing platform. It's a much higher percentage, and I think in some cases that's going to require a lot more work to get comfortable that you can properly integrate it. And at some point, it starts to look almost more like a merger or something like that
Yeah.
versus, hey, we're taking this big platform and sort of tucking
Yeah.
in the smaller player.
Yeah. Okay. Cool. Cool. So let's say there's a company and the owner's decided that he wants to explore a potential sale of the business, and he's in the market. He's gotten a bunch of offers. Um, a percentage of those offers are from guys like you that are sort of in the institutional private equity space. What advice would you give that owner as he's sitting there and he's got maybe five offers on the table, and it's five different private equity groups, and we'll talk about the deal structure in a moment. But let's say that the price that everyone's willing to pay for the business is approximately the same, and the deal structure is approximately the same. What are some things that you would encourage that owner to think about when he's selecting which one of these offers he thinks is the best fit for him? And then when you're sort of pitching yourself to that owner, what are some of the characteristics and qualities of your business and of your sort of culture and what you guys are building that you think makes your story particularly attractive and appealing to these sellers?
Yeah, I mean, it's a really tough decision, right? I mean, it's going to be one of the most important decisions that one of these business owners probably ever makes in their life.
Mhm.
So it's definitely worth. And if you're in a position where you've got five kind of economically
Yeah.
equal offers, then I think you're in a really good spot. And so I think there's probably a couple things if I was sitting in that seat I would think about. I mean, I think one is what do you want your role to be going forward, and what do you truly envision? Are you looking to step back from the business? Are maybe you're a little older, or you're burnt out, or you want to spend more time with your kids, or you have some other passion you want to go pursue. Maybe you're on the other end. You're younger, or you want to bring in a partner because you're seeing a ton of opportunity and you want to grow the platform and really charge hard at it for another 4 or 5, 6 years, whatever it might be. And so I would think about what do you want your role to be, and who's really going to facilitate that for you. Are you and that investor aligned, and do you feel comfortable with what they're telling you they want that role to be? I think that's one thing I would think about. I think a second, this sort of is in some ways it's obvious, but I think it's something that people probably should think about more, which is you're going to be spending a lot of time with this investor
Right.
over the course of several years, and just that kind of a human, both at a business level, but at a human level. I mean, do you genuinely enjoy spending time with that person, or have you picked up on some red flags or things that sort of give you pause? I mean, do I want to be spending hundreds of hours of my time with this person or this set of individuals? I think that's something else to think about. And then I think the third one is I would really try to figure out which which group that you're thinking of partnering up with has the same vision that you do for the business, or that's maybe bringing a different perspective that you're now buying into. Maybe they thought about some ways to grow the business, or strategically some things that they think are interesting that really cause you to say, hey, that's interesting. I hadn't thought of that before, and that's something that gets me excited. I think if there's some misalignment there, then that's where you run into issues.
Yeah,
Um,
those are great points.
yeah, so I think there's a lot of things to think about. You said they're economically equivalent. That's obviously the other piece, terms and all of that. But I think there's some real qualitative things that you need to think about.
So let's talk about deal structures, and we've alluded to this a couple of times. When we're beginning to work with sellers and help them understand deal structures, we generally say there potentially can be four components to it. There can be a cash component to it. There can be a note component to it. There can be an earnout component to it. There can be a rollover equity component to it. When you guys are structuring deals, are you considering all four of those options, or are you dialing it back? And where are you? I know it's hard to say what's typical, but if you had to sort of generalize where the deal structure more times than not is sort of falling, what does that deal structure sort of look like?
Yeah, I think we're very. I mean, this maybe sounds cliche, but we're very flexible. So we will, if we like a business, we like an owner, we want to make something happen, we'll try to figure out if there's some roadblocks like we're getting stuck on. There's a gap between what they think the business is worth and we think the business is worth. We'll try to figure out, is there some way to bridge that gap and get creative. Having said that, I think as a general rule, the simpler you can keep the terms, I think the better it is for us and the better it is for the seller.
Right.
Easier to explain. It's easier for us to all understand it. It's easier to all feel like we have alignment. And ultimately, we don't want to create some structure where either party feels like we're not kind of in the same boat rowing together. Like
Right.
there's some sense, even if it's not in practice that there's necessarily a misalignment. Sometimes you can feel like there's a misalignment. So we generally prefer simpler structures, but all the items you've mentioned are kind of tools we've used in different
Right.
deals. I
Right.
would say our firm has a preference for existing owners. Two elements. Our general preference, not always, but generally our preference is for it to find an existing owner that we feel like is really strong and can lead the business going forward, and that we can partner up with him or her.
Right.
And I think if that's not the case, we can bring someone in, or create a transition plan. So to that end, we really like deals where the existing owner, continues to own a large chunk of the business. And generally, I mean, as a general rule, the more the better, and just creates great alignment, right? They feel like they're invested in the success of the business, and we are too. So I would say that's maybe one thing I would highlight on the rollover equity. We would really struggle to do a deal where the existing owner was just kind of walking away, didn't have any ongoing incentive in the success of the business.
You are buying majority control, right?
That's our general preference, but we've
Okay.
done minority deals too. So we've done
Okay.
deals where we've bought, for us, minorities like owning 25 to 49% of the
Okay.
business. So we don't want to be a 5% owner in something. We
Yeah.
want to be a substantial owner.
Okay.
Yeah,
So let's take a deal, just to sort of use a case study. Let's take a deal that's got an enterprise value of maybe $10 million, because the math is easy. And let's say you're buying 75% of the business, and let's say the owner is rolling over 25% of the business. If you were talking to that owner and helping him or her wrap their head around that rollover equity component of 25%, which is 2.5 million, exactly what is that money being invested in, and and what sort of return would they expect to receive off of that rollover equity over what period of time?
yeah. So, and sometimes it's the answer's more complicated when if we're
Yeah.
using debt,
Right.
because the seller gets the benefit of employing leverage on the deal. But let's not overcomplicate it.
Right.
If that seller is effectively reinvesting $2.5 million back into the deal,
Right.
and we'll use different types of equity, but I would say generally, if the deal is successful, we want to be sitting side by side with that seller, with both of us sitting in common equity, same type of shares, all of
Right.
that. And what we're really trying to do is, for our firm, for our investment, we are trying to generate above average returns. So on most deals, like what would above average be? It'd be probably 4xing or more of our money. Ideally, really having a good chance of something much more substantial than that. And we have done that before in deals. Um, so if you think about 4x in $2.5 million, I mean, it's worth $10 million. If you 8x it, it's worth 20 million, et
Yeah,
cetera, et cetera.
yeah.
Generally speaking, um, and our goal, like something that we really strive for, is we want the rollover stake that that owner has, their ongoing ownership, to be worth more in, call it, 5 years than the money they're taking off the table today,
And
because we've worked with them to grow the business.
so,
And we'll sit.
so it's possible they could get a check today using my example of 7.5 million, and they're rolling 2.5 million over 5 years. Let's say that 2.5 could be worth 10, and so that second check, that second bite, so to speak, is much bigger than the first bite.
Absolutely. I mean, and the way that we'll sit down with the owner before we do a deal. I mean, we're trying to come to terms and everything and show them a path, like what is the path to get there.
Yeah.
And I think this is a difference between us and some other firms. I mean, we we only do a handful of deals. So we intentionally have a relatively small concentrated portfolio. So
Mm-hmm.
we're invested in a handful of companies at a given time. And
Mm-hmm.
what that means is that our risk is more concentrated. We don't have a portfolio with 50 companies,
Mm-hmm.
but we're also very personally invested. Our personal net worth is highly tied up in these companies.
Mm-hmm.
And for it to be worth our time to only do a handful of investments, we need to generate a better than, we're not interested in two timesing our money,
Right.
which is what a lot of firms will do. And so we want to generate that above average return on our own money, and the sellers that we're partnering with, the other owners, are going to benefit from that if we do our job right.
That's very attractive. It's very attractive. So let's continue to walk through the process here. So you found a deal that you like. You've submitted an offer. The seller is comfortable with the offer and comfortable with the structure and comfortable with you guys. And so an LOI is signed at that point. At that point, we sort of enter the due diligence legal review phase. What does that phase look like? And how long does that phase typically last? And what should the seller be prepared for as they're working through the various components of that phase?
Yeah, I mean, short answer for what does it feel like is probably painful. I think these processes end up. I think sometimes we forget this as an investor because we sort of do this for a living, right? And we've been through this many times, and it's what we do. If you're a business owner, maybe you've been running your business for 30 years, you never sold it.
Right.
This is maybe the only time you do it in your life. So I think what I would say as a general rule is that it's much more time consuming, and than people expect, every aspect of the process. And I think that's something to just be prepared for. Um, but to answer your question, like post LOI specifically, I mean, we're usually trying to close a deal within, call it, it's going to vary, but call it within 90 days.
Okay.
So within 90 days, we want to get to the finish line. Our goal is for most of the business diligence, like really the business diligence, the core building of our thesis around what are we going to do with this business? Why do we believe this is going to be a successful investment? That we've completed most of that. There may be some outstanding questions or some really detailed work we want to do to confirm what we think, but we're hoping to have really completed most of that by the LOI stage. So when we get to LOI, I would say that the two big work streams are, quality of earnings, which we
Right.
call Q of E report, which is, we're going to bring in an independent accountant. They're going to go through the books, ask for a bunch of data, and confirm that our understanding of the financials is what we thought it was. That's one component. And then the other is legal. And there's a lot of work around legal to sell a business, to sell or buy a business. And so there's going to be a lot of back and forth on that, a lot of paperwork. But I would say those are the two, not the only ones, but those are really the two probably big work streams that kick off post LOI. And then I think the other one is at that point, we're trying to spend a lot of time with the team and really get prepared that, I mean, we're assuming we're running this business, and that what is our plan? What together with management, with the owner, what are we going to do day one? And, day one, year two, what are we planning to do with the business? And so spending a lot more time on that.
Okay, so let's say it's an HVAC business, and let's say it's a $10 million HVAC business, and let's say it's the owner and they've got maybe 40 employees. Okay, as you're progressing through, and as you're getting close to close, at what point does the owner begin to bring part of the management team into the discussion? You guys meet with the management team. At what point does the owner typically make a general announcement to all the employees? How is that sort of cadence managed?
Yeah, every owner handles it differently. So we've had opportunities or deals where, I mean, from the beginning, the owner's been totally open with all his employees or her employees about, this is what we're trying to do. This is what I'm trying to do. This is what I intend, why it's going to be good for you, where some of the risks might be, and open conversation. Everyone knows this is happening. It's not some secret. And we'll walk around the office or shop floor, whatever it is, and it's not a big deal. Everyone understands it. Other people take a more closed approach, right? And there's good reasons, I think, to do one or the other. And owners get to assess what makes sense for their business.
Right.
And so we've had situations where that they're the only person that knows that this is happening or prospectively happening, right? I think what we generally see is usually as we get later into the process, like down the road an LOI, and in that latter case, the owner's starting to feel more comfortable that, hey, this is really happening and I trust these guys. They will at least bring in a few of their closer members of the management team. And we're typically going to want to meet those people too, because it's a small company. We want to meet the key team members, get to know them. In terms of a sort of company-wide announcement in that case, oftentimes that may not happen till, the day we close or a couple days after we close, or maybe a few days before, depending on what the situation is.
Got it. Okay. The deal closes. It's the next day. What feels different the next day for the employees, and what feels different the next day for the owner? What feels the same in each of those groups' lives, and what feels different in each of those groups' lives?
Yeah, I mean, I think we don't want to we're usually not trying to radically change things or come in, we don't want to come in with a hammer day one and try to change everything. And hopefully we're investing in a really good business, and there's a lot of things that are going well, and it's not about changing, or it's about just over time improving and strengthening the business. So my hope would be, I mean, literally on day one, there's not some major difference, but like over time, we're layering in new things. So an example of this would be, like, a very common example would be that oftentimes one of the weaker functions when we come into a business is the finance function, kind of finance and reporting. Oftentimes business doesn't have a CFO, or, I mean, in some cases they're literally managing the books by hand. And, we're big part of what we do is finance. And so this is oftentimes an area where we focus. And so over time, we will layer on more reporting. So different ways of looking at the business, figuring out, maybe we need to implement a new system to manage the information, financial information. And so that takes time, but those are sort of things that might get layered on over the course of several months. And so I think that's an example of something that's going to probably over time start to feel a little different. But I don't think we want it to, things are going to change, but I think if the business is already being run pretty well and it's growing and all of that, it should not be some radical, that should be a radical change.
What about the owner? What changes from the owner's perspective? these owners, they've bought this business or they started this business 10 years ago, 20 years ago, 30 years ago, and they've been doing their own thing. And now all of a sudden they've got a partner that owns majority interest in the business typically. And so, I mean, that's got to be weird for some guys. And and they've got to wrap their head around, it's not just them, but there needs to be a little more structure because there's another partner invested in the business, and in that partner, there needs to be some reporting so that so that the new partner now can be informed on how the business is progressing. And so, how cumbersome does that look and feel like? And are there situations where you might have owners and when they look at their job description, there are 20 different things on there, and a third of those things they don't enjoy doing and they're not very good at. And so there's a chance to maybe shift some of what the daily responsibilities are to get the owner sort of back focused on the areas of the business that they feel like that they enjoy the most and they're really good at.
Yeah, I think it's a tough transition, right? You're going from you're running the show, you own the business, you can kind of do whatever you want or not want.
Right.
To yeah, now you have someone else that at the end of the day, they're an owner. Um, and so I think different people probably struggle with that more than others. I think there's some owners that maybe underestimate how that might feel, just even sort of psychologically, or
Yeah.
you know, so, and I think there's other people that thrive, right? Because I think one of the challenges sometimes when it's very lonely at the top, or you're every decision you're making, it kind of comes out of your pocket, right? Every investment, there's no separation between your business and your
Checking accounts
personal
get hard
finances.
sometimes.
Yeah, and I think now you have a partner that can. I mean, a big thing we find is that a lot of owners are lacking and really really value the fact that we're not in the day to day, right? We're able to step back a little bit and sort of see the big picture, and provide a perspective that they just haven't had on the business. Um, but I think the transition is tricky. I think a big benefit a lot of times is I think a big thing we focus on is where can we strengthen the management team.
Mhm.
And to your point, a lot of owners are stuck in the day to day, just all the day to day crap you have to do with running a business. And there's not as much time for those strategic initiatives,
Right.
right? Maybe there's something that they've wanted to chase, but they haven't had time for it, or really thinking about something that might be transformative for the business. And
Might
so
be
if we can build out that,
a new service line. It might be expanding to a new geographical market. All sorts of things that they've not had the bandwidth to focus on, and maybe they haven't had the capital to they've been uncomfortable risking the additional capital to maybe make that investment.
yeah, exactly. And I think owners, I mean, you sit down with an owner that's been running their business, they're going to have a lot of really awesome ideas on how to grow it. But a lot
Yeah.
of times what they have to do on really a day-to-day basis is they can't focus on that. They have to focus on just keeping kind of keeping the lights on. And
Yeah.
when you have a small team, I mean, there's a bunch of things they're doing because there's no one else that can do it.
Yeah.
So sometimes we can help facilitate freeing up their time. I mean, it's going to be situation dependent, but
Yeah.
in some cases, that owner says, "Hey, I don't want to be CEO anymore, but I want to have a role that can focus on partnerships. I want to spend my time on sales, or I think there's a big opportunity to go acquire some competitors, and I want to focus on that." And so maybe we can create a path to bring in someone that's like a general manager that's doing a lot of that other stuff, and that owner can then focus on that. Or maybe they want to stay CEO, and we say, "Hey, maybe we bring in a COO or VP of operations or something that can take a lot of that minute by minute, day by day work you're doing off your plate." So I think those are the types of things that we can probably help with,
Awesome.
and it can be a big benefit.
Yeah. So if an owner if they're thinking about or they're beginning to think that they're ready to begin to have this conversation, and they're ready to explore the possibility of selling majority interest in the business and become part of a bigger group like yours. What what are some things that you would encourage them to think about to be sure that they're ready to begin these conversations, things that maybe they haven't thought of?
Yeah, I think the first thing, and we see this a lot, is sort of people will sometimes in a process change their mind. So decide they don't want to sell the business or they only want to sell a minority position or something like that. So I think the first thing is I would really try to figure out what do you want.
Right.
Um, and I think there's some tactical things you could do to get more informed and get perspective. So I think one, for example, would be to talk to some other owners, other
Mm-hmm.
business owners who have sold their business to private equity or someone else and get their perspective. I mean, here's some of the good stories, try to hear some of the bad stories
Mm-hmm.
and sort of know what you're getting into, also get some advice on what you should be looking for. And I think going through that will help you figure out, I mean, do you really want to do this, or is now really the right time?
Mm-hmm.
So I think that's one thing. I wouldn't just launch into a process and then start having those conversations, because that can lead to I mean, in addition to just wasting a lot of time, it can lead to a bad outcome. I think there's some stuff that needs to happen at the business. So I think in terms of, and I think this is where, having a really good advisor like you or someone else will help, because you know what they should, what these things are that we're looking for, and you can help them prepare that and get ahead of it. But we see this all the time where people will try to sell their business. They'll bring it to market. They'll start approaching people like us, but they don't have financials,
Right.
or there's some obvious information we might be looking for. You know, I'm making this up a little bit. We want to see revenue by customer for the
Yeah.
last couple of years,
Yeah.
and they can't produce it, or it's in some really messy format. And that, if you go to market without that stuff, it's going to slow down your process, or you're going to lose interest. People like us, maybe we lose interest or we get busy on something else. You want to kind of have all your ducks in a row in terms of what information you need. And I think the final thing is I would think about what are red flags for someone like us. And you really need to, in advance of selling your business, I think to get the most value, to have the most interest, you need to start working on those. So if you have no team, you need to think about, like, can I bring some more people in here to create a real management team? If you have very poor financials, try to over the course of a year, say, improve that. Maybe you work with an outside party to improve that. If you have a ton of customer concentration, we see this all the time. You got one customer that's 60% of your business. I mean, this is a hard one to solve, right? I mean,
You can't solve it overnight, but you can work on it because it's going to matter.
Yeah, and that might be the sort of thing that you really need to work on over the course of a couple of years.
Yeah. Yeah.
So I think there's things like that, that I think are important.
Well, that's great advice. Great advice. Well, listen, thank you so much for all of this. It's been a great conversation, and we'll be sure and put your contact details in the show notes. And if someone wants to reach out to you and have a conversation, what's the best way for them to find you?
Shoot me an email. We're always happy to talk, even if you're not sure. To some of the points we're making in this conversation, you're not sure what you want to do, you're not sure what the options are. We're happy to just talk confidentially, give some ideas, even if it doesn't involve us. So yeah, just reach out. This is what we do, and we love sharing advice and learning about people's businesses and trying to be helpful.
Well, great. We'll be sure and put your contact details in the show notes. Listen, thanks so much for your time. This has been very informative, and we'll be in touch.
Thanks, John.
Okay.
Appreciate it.
Thank you. Have a good day.